Violations of stability and balance in the U.S. financial system amid contradictions between the U.S. Treasury Department and the Federal Reserve System. The U.S. financial system relies on a delicate balance between fiscal and monetary authorities to maintain economic stability, control inflation, and foster growth. The U.S. Treasury Department, led by the Secretary of the Treasury, manages the government's finances, including issuing debt to fund federal spending, collecting taxes, and overseeing fiscal policy. In contrast, the Federal Reserve System, the Fed, an independent central bank chaired by the Federal Reserve Chair, conducts monetary policy through tools like interest rate adjustments, open market operations and balance sheet management to achieve its dual mandate of maximum employment and price stability. This separation ensures that short-term political pressures do not unduly influence long-term economic decisions, a principle enshrined in the Federal Reserve Act of 1913. However, contradictions between these institutions, arising from misaligned policies, political interference, or external shocks, can disrupt this balance, leading to violations of financial stability. Such disruptions manifest as market volatility, liquidity strains, inflationary pressures, or even systemic crises. In recent years, particularly from 2024 to mid-2025, escalating tensions have highlighted these issues, exacerbated by large fiscal deficits, monetary tightening, and political dynamics. This article examines these contradictions based on factual analyses from official reports, market data, and expert assessments, exploring their causes, manifestations, and implications for the U.S. financial system. Historically, tensions between the Treasury and Fed have often stemmed from differing priorities, the Treasury's focus on funding government operations versus the Fed's emphasis on economic stability. A landmark example is the 1951 Treasurer-Fed Accord, which ended the Fed's World War I-era obligation to peg Treasury yields at low levels to finance war debt, granting the Fed greater independence to combat inflation. This accord resolved a direct conflict where fiscal needs suppressed monetary autonomy, but it set a precedent for ongoing negotiations. In the 2008 global financial crisis, coordination improved temporarily as the Fed launched quantitative easing, QE, to purchase Treasury securities, effectively supporting Treasury's massive borrowing needs amid fiscal stimulus. However, this blurred lines, raising concerns about monetising debt, where the Fed indirectly finances government spending, potentially fueling inflation. During the COVID-19 pandemic, 2020 to 2023, similar dynamics played out. The Treasury issued trillions in debt under stimulus packages, while the Fed expanded its balance sheet by over $4 trillion through asset purchases, stabilizing markets but sowing seeds for post-pandemic inflation. These historical episodes illustrate how alignments can avert crises, but misalignments, such as fiscal expansion clashing with monetary restraint, erode stability. By 2024 to 2025, with public debt exceeding 120% of GDP and inflation lingering above targets, these patterns resurfaced in amplified form. In 2024 to 2025, direct conflicts between Treasury Secretary Scott Bessent and Federal Reserve Chair Jerome Powell under President Donald Trump's administration have intensified, threatening the Fed's independence and financial balance. Trump, known for criticizing the Fed during his first term, escalated pressures by publicly questioning Powell's leadership over interest rate decisions and operational issues. A notable flashpoint was the Fed's $2.5 billion headquarters renovation project, which Trump and Treasury officials accused of mismanagement and cost overruns. During a July 2025 visit to the Fed's headquarters, Trump debated Powell on the expenses, using it as leverage to demand rate cuts. This led to speculation about firing Powell, whose term ends in May 2026, though legal experts note the Federal Reserve Act allows removal only for cause, not policy disagreements. Bessent, confirmed as Treasury Secretary, called for a comprehensive review of the entire Federal Reserve in July 2025, signaling potential structural changes that could undermine independence. Trump ruled out Bessent for Fed chair in August 2025, narrowing candidates to 4 others amid ongoing tensions. These personal and political frictions reflect broader contradictions, Treasury's alignment with executive fiscal agendas, e.g., tax cuts and spending, clashing with the Fed's data-driven approach to inflation control. Such interference risks eroding investor confidence, as seen in historical precedents where political pressure on central banks led to policy errors and market instability. Core contradictions in 2024 to 2025 arise from divergent policies, the Treasury's issuance of record debt to fund persistent deficits, 6 to 7% of GDP, contrasts with the Fed's quantitative tightening, reducing its balance sheet by $176 billion in early 2025 to unwind pandemic-era stimulus. This mismatch has strained the Treasury market, the world's largest at $29 trillion, amplifying vulnerabilities. Elevated Treasury supply, driven by fiscal needs, has crowded out private investment and challenged market liquidity, as noted in the Fed's April 2025 Financial Stability Report. Survey respondents highlighted fiscal debt sustainability as a top risk, 33%, with concerns that large issuance could raise term premia and impair dealer intermediation. Dealers' balance sheets, constrained by regulations like the Supplementary Leverage Ratio, SLR, limit their capacity to absorb bonds, leading to volatility. A Boston Fed study found that relaxing SLR could improve liquidity, but stricter rules have reduced Treasury holdings and increased costs. The IMF's April 2025 Global Financial Stability Report detailed how US Treasury yields spiked post-April 2, 2025, tariff announcements, with leveraged non-bank financial institutions, NBFIs, unwinding positions, amplifying sell-offs akin to the 2020-4 cash. Hedge fund leverage reached highs since 2013, exacerbating risks. The BIS echoed this, noting the Fed's $1.5 trillion reduction in Treasury holdings since mid-2022 raised yields by 80 basis points, shifting absorption to price-sensitive investors and increasing fragility. Experts' opinion underscore these issues. There is a doom loop where the Fed quantitative tightening reduces liquidity, heightening volatility in treasuries. Another highlighted banks misreporting assets and unsettled trades flooding markets, potentially tied to regulatory gaps between Treasury and the Fed oversight. Fiscal stimulus, including extensions of the Tax Cuts and Jobs Act adding $37 trillion to deficits over 30 years, conflicts with the Fed's rate hikes to curb inflation. The IMF noted trade-offs, tightening policy to fight inflation risks financial instability as higher rates devalue fixed-rate assets, e.g., $479 billion in bank losses by late 2024. Tariffs, a fiscal tool, acted as supply shocks, raising inflation expectations and complicating Fed easing. Stablecoins, holding trillions in treasuries, introduce new risks. Mass redemptions could force fire sales, bypassing Fed control and giving Treasury indirect monetary influence. The Financial Stability Oversight Council, FSOC, chaired by the Treasury Secretary, identified cybersecurity as a growing threat, with cyber events amplifying traditional vulnerabilities. Risks shifting to NBFIs due to bank pullbacks highlight policy gaps, as Treasury pushes reforms like central clearing while the Fed monitors leverage. These contradictions have violated system balance, leading to market volatility. Treasury liquidity hit historical lows in April 2025, with depth deteriorating amid volatility. Higher costs, elevated yields raise borrowing expenses for households and businesses, with mortgage rates sensitive to policy interference. Systemic risks, leveraged positions in treasuries pose financial vulnerability via margin spirals, as warned by the BIS. Delinquencies rose on consumer loans, and CRE refinancing, $1 trillion due in 2025, faces strains. Global spillovers, U.S. policy uncertainty overshadows global outlooks, with trade tensions dragging growth by 0.25 percentage points. Contradictions between the U.S. Treasury and Federal Reserve, fueled by fiscal monetary misalignments, political interference, and external shocks, have undermined the stability and balance of the U.S. financial system in 2024 to 2025. While reforms like Treasury buybacks and central clearing offer mitigation, persistent deficits, quantitative tightening, and tensions risk amplifying vulnerabilities into crises. Restoring balance requires reinforcing Fed independence, aligning policies through bodies like FSOC, and addressing debt sustainability. Without action, the system faces heightened instability, with potential for broader economic fallout.